And a very warm welcome to everyone, wherever you may be in these digital times. I hope you're keeping safe and sound where you are. So it's a pretty big day today, so I feel like we are sort of the warm-up act here at SKAGEN Kon Tiki. Unfortunately, there is no crystal ball where we are sitting right now, but no doubt the election tonight will have some form of an impact, both short and longer term. However, trying to gauge that is pretty noisy in our view, and something that is entirely outside of control. So we actually try and minimize the time that we spend on it and focus on our portfolio companies instead. But as many of you will know, emerging markets are often volatile end of the spectrum. But the US sure knows how to keep us on our toes at the moment. Another thing that's kept us on our toes recently and probably has affected many of you around the world is, of course, COVID-19, which has had a pretty big impact on this year. Again, it's not something that can be easily analyzed, but it has created a number of headwinds, but also a few opportunities for SKAGEN Kon Tiki over the last 7 or 8 months. And I think whatever happens tonight or whatever happens in the next week or so, I think we can expect more of the same, and that's what we're preparing for. So compared to our last update in the middle of June, we're going to change the order a little bit around. So we're going to start off talking about what we have done in the portfolio since June, because these are the things that we can control. And then we will give some reflections on the market and most importantly, how we see the outlook from here and why we're still pretty excited about the opportunity ahead of us. Before we go there, I think it's worth highlighting that the team remains fully operational. Our head office here in Stavanger is still open, and we continue to run a mixture of physical and digital presence. Obviously, face-to-face meetings, both with portfolio companies and with clients, is more limited than we would have liked, but we have seen activity levels remain very high through digital channels over the last month. So if we turn our face to the portfolio, this is a snapshot of what it looked like at the end of May, and I always like to start with this because it frames how we look at SKAGEN Kon Tiki and also the discussions that we have around performance, etc. It also should give you an expectation of what you can expect from the portfolio. So when we look back, sort of 5 months ago, the market had started recovering, and the portfolio was trading at a reasonably attractive discount to the market, and we've rebounded with the market since that time. But what we have seen since then is that the market has become significantly more expensive. That's through a combination of relatively lackluster earnings movement, but also much higher share prices. And what we've done in this period is to continue to try and manage the portfolio so that the overall characteristics of the portfolio have remained equally attractive. So the portfolio continues to trade at around 11 times earnings, less than 1 times book, and we continue to have an active share of around 90%. But for those of you who spotted the green bars, you can see that the index has actually become much more expensive. And on current year earnings, the MSCI EM index is now trading on over 17 times earnings and nearly 2 times book. So what that shows you is that through managing the portfolio and keeping up with the market, we have continued to build the discount, and therefore we think that the relative opportunity is even stronger than perhaps it was just 5 months ago. We've also seen a number of opportunities that we've added more in the large cap space, as some cyclical names have become more less expensive. So we have seen the share of large cap weighting in the portfolio go up a little bit. But other than that, the overall characteristics have remained the same since our last update. If we look at the year, we mentioned the rebound, and after what was a very challenging first quarter where the fund fell by 25% in euro terms, underperforming the index by 5%, we have since rebounded relatively nicely up 16% in the second quarter, which was underway during our last update, and we've rebounded a further 7% since then, broadly in line with the overall index. We're obviously not happy with trailing the benchmark by 5 percentage points year to date, but it is worth pointing out that during this period, value stocks have significantly underperformed as a factor this year. And if you look at what the differential has been year to date, it's nearly 30 percentage points within the index between value and growth. So given our value philosophy and positioning, the 5 percentage point underperformance year to date should be seen in the context of that. But we will spend some more time on that as we go to the outlook. If we look at the portfolio drivers, the key detractors, if we start on the right-hand side of the chart, have largely been from the financial sector and banks in particular. They are all suffering from lower rates for longer and also heightened risk of bad loans in their portfolios. So that kind of macro trade has been a negative one for those. Also, as we mentioned last time, we did sell out of our Russian airline holding Aeroflot, which has also been hit very hard this year and has been detracting from the portfolio. We did, however, sell out before the company recapitalized, and the shares have been even weaker since we exited that position. Another company that has recapitalized during the year is land-based salmon farmer Atlantic Sapphire, which is the biggest detractor year to date. But it is worth bearing in mind that this has been one of our very best performers since entering the portfolio in 2017. And we've actually seen the recent fall on weaker salmon prices to be a huge buying opportunity, and we have now added back to the position, having sold out a little bit earlier in the year. In terms of the key contributors on the positive side, they come from various sectors and countries, but in terms of themes, one that we've been talking a lot about recently has been in the electric vehicle value chain, and you see both battery maker LG Chem, but also our copper production ramp-up player Ivanhoe Mines has also been making a significant positive contribution this year. And the biggest mine that they are developing in the DRC is now only 9 months away from ramping up production. The biggest contributor year to date has, on a single company basis, has been Naspers. Again, we talked about that last time, that we added to the position as the discount to its holding in Chinese internet company Tencent widened, and we have now seen that has started catching up again. And we also note that the company announced a $5 billion buyback with its subsidiary Process, which we believe will continue to narrow the discount to 10 cents. We see still very attractive upside there. We also, within the Naspers sphere of companies, had received shares in MultiChoice, which is an African pay TV operator. That was another company that sold off during March that we added back to the portfolio and also has contributed very strongly, where there is now also Canal Plus has taken a stake in that company. So other people have seen the upside there. Finally, it's worth highlighting Tech Mahindra, which is a relatively new position in the fund. We only added it in May this year. We think that's a fantastic way to play 5G capex cycle, and also they have a big catch-up opportunity in terms of margins against their closest peers. And we've seen that become already a pretty significant position in the portfolio and a top 5 contributor in a short space of time. If you look at what's been going on in the portfolio so far this year, these are the key names that we have added. I already mentioned Tech Mahindra and MultiChoice, but we also added a number of Chinese companies, which are highlighted in green here, where we see pretty significant upside potential from low levels. On the technology and 5G side, which we mentioned for Tech Mahindra, we have positioned ourselves through adding Foxconn Industrial Internet, but also their Taiwanese parent company, Hon Hai, which many of you may know as one of the biggest iPhone assembly companies in the world. We also added the world's largest pork processor, WH Group, on the expectation of improved margins in China, but also it gives us an upside trigger for any US reopening in 2021, because the company has suffered from lockdown impact on demand there in the current year. We've also added a couple of mid-cap names with packaging company Samyang out of South Korea. It's a very stable, attractively positioned company. And we've also added Lenzing, which is an Austrian listed producer of sustainable materials, particularly for the clothing and textile industry, where we see pretty significant long-term upside as they add to their production capacity, both in Thailand and in Brazil. As I mentioned, we've already exited MultiChoice, which is why that is in the shaded, but we've also seen a number of other holdings exit the portfolio so far this year. We mentioned last time that we had reduced our exposure to the energy sector, predominantly through our sell down of Royal Dutch Shell, where we had a thesis violation on the big cut in the dividend. We also reduced our banks exposure. We talked about State Bank of India last time, where we see mounting bad debt problems, but we have also exited Bangkok Bank in Thailand, which had been a relatively small position for us, and we freed up that capital for new ideas. We've also exited some telco companies, predominantly because we see the technology value chain and Tech Mahindra as better place on 5G, and we have not seen the operational development at these companies that we would have liked to have seen for the thesis to play out. Obviously in transport we sold out of Aeroflot, but we also exited Brazilian rail operator Rumo, asset traded close to our target price. And we have also recently exited Samsung SDI, which is our other Korean battery manufacturer, as the shares were trading above our estimate of fair value. So we have recycled those money into new ideas. So what that means at the portfolio level is that we've seen a continued pickup in activity levels. So the fund turnover velocity over the last 12 months is now about 34%. Which is broadly in line with what you'd expect from our investment horizon of 3 to 5 years. And as we've mentioned earlier, it's been a focus of the team to make sure that we have a steady stream of new ideas to outcompete older holdings in the portfolio. Why do we do that? Simply speaking, because we see that in aggregate, our new positions are contributing more positively than those that they compete out. So if we look at the portfolio returns over the last 2 years or so, the majority of those returns have come from positions that have been initiated since June 2018. And we're now in a position where we feel that the quality of the portfolio is at a very high level, and any new potential position that we consider has to outcompete something that is already there. So that's what we've been up to over the last 5 months. What do we think about the market right here and what's been driving it? I think the first thing to mention is that the backdrop continues to be pretty uncertain. We've gotten used to this this year. As you can see here, the volatility index, the VIX, is now in the mid-30s. That's a pretty high level in a historical context outside times of stress. We obviously had a pretty significant peak in the first quarter this year, but I think, as I mentioned in the introduction, our expectation is that the market backdrop will continue to be uncertain and at times volatile. It's probably therefore no surprise that safe havens have performed well this year. If you look at gold at the top of the chart, it's up more than 20% year to date in US dollar terms. Similarly, US Treasuries have outperformed US equities, and more cyclically sensitive asset classes such as commodities and oil in particular have performed pretty poorly so far this year. So when we talk about the V-shaped recovery, I think in many instances it's predominantly in financial assets rather than in activity levels. And as you can see on the right-hand side, the S&P 500 recovery that we've seen since the end of March is not only the fastest recovery on record, but it is also one of the biggest. And if you compare it to other significant market drawdowns, it is now in the same ballpark level of recovery. If we look at the equity returns by country, as is often the case, there's a wide range of returns year to date. Of the markets that we look at, Brazil down 45% in euro terms, largely due to FX, but also weakness local currency. And the other end of the spectrum, you have the US Nasdaq index up almost 20% in euro terms. I think what's interesting this year is that on a regional basis, US has been strong. Plenty of people are writing about that. But emerging markets now, as at the end of October, have actually outperformed the world index because it's been held back by the weakness in Europe. As I mentioned earlier, Kon Tiki has recovered some of the ground lost in the first quarter, but we have been held back on a relative basis due to our underweight in China, which is one of the best performing markets so far this year. But we are sitting pretty much in the middle of sort of the median of the markets in which we invest in. I mentioned last time that the US dollar had been strong. It has since weakened quite significantly, and it's therefore no surprise, at least if you look at historical correlations, that emerging markets have performed strongly. On the left-hand side of this chart, we have inverted in green the US dollar index. So that means the higher the green line is on the chart, the weaker the US dollar is. And in the blue line, you have the relative performance of emerging market equities relative to developed markets. And what we see is that there is historically a strong directional link between a weaker US dollar and outperformance of emerging market equities. That's also been the case so far this year, and in particular so since our last update. So I think, whatever happens after the election tonight, the combination of fiscal and monetary pressures in the US means that the US dollar direction will be quite important again for emerging markets relative performance. But what we've seen since our last update is in line with what we would have expected given what's going on. The second reason why emerging markets in our view has done well since our last update is that, strangely enough, they are having a relatively good corona crisis. Many countries were early into the crisis, but especially China, where we saw stringent measures by the authorities, but also perhaps aided by some cultural peculiarities in much of North Asia. As a result, we've seen no evidence of a so-called second wave. But as you can see here in the black line, both Europe and in the gray line, the US is now, at least on a relative basis, struggling versus many of the larger emerging market economies. So I think that also explains part of what's happening, that the second wave and the impact on EM domestic economies. And it's worth highlighting that these countries are now more dependent on domestic consumption than they have been in other periods of crisis. And that has also helped on a relative basis in our view. But the defining characteristics of 2020, in our view, has been the flight to growth at any price. Here you see the various regional equity markets. So on the left, from the left-hand side, emerging markets and then developed markets split into US and ex-US, and also all world. And here you see that for every single regional index, the differential in performance between value and growth is roughly 30 percentage points year to date. This is outside of any historical observation other than during the dot-com bubble. We've seen huge concentration in fewer and fewer stocks, the so-called biggest winners. And if we take the S&P 500 as an example, the biggest 5 companies at the start of the year being Apple, Amazon, Microsoft, Google, and Facebook, they have driven all of the year-to-date index returns in the US, while the other 495 stocks have delivered negative index returns. What is it that's driven that? In many examples, it's not earnings that's driven it, it's only been a re-rating. And here we will use Apple as an example of what has happened in recent years. So if you look over the last 5 years, Apple's operating profit after tax, the green line, has increased by about $4 billion on a trailing 12-month basis, while at the same time the enterprise value has increased by $1,350 billion. So if you put a multiple on the incremental earnings and the incremental EV, it's over 300 times. What that means is that on a trailing 12-month basis, the stock has gone from 8 times to 31 times net operating profit after tax. So what we show here is that if you had kept the earnings multiple stable 5 years ago and only gotten the earnings uplift at that multiple, you would have added $32 billion of enterprise value to Apple. But instead, the company has added more than $1,350 billion of enterprise value, with the difference having come from re-rating of the shares. Now, we can talk about how Apple was clearly undervalued in 2015 with the benefit of hindsight, but the real question here is, can it continue to do what it has done over the last 5 years to see that kind of re-rating? No doubt, looking back, the polarization of the market into these type of growth winners and re-rating stories, especially in developed market, has held back the Kon Tiki performance relative to global funds. These powerful headwinds we think are coming towards an end. And if you look at the left-hand chart where you see the EM versus DM performance, you may see that on a trailing 12-month basis, emerging market equities have come back a little bit to life. There is no such life in the value versus growth chart, where we have had to change the axis on the chart in the middle. But as we will go through in the following section, we think that that is a source of great opportunity. So how are we positioned going forward? So I think just to set the stage, I think it's worth making sure that we explain how we think about this. Firstly, market returns are more volatile than company returns. What that means is that the stock market returns here in the green line, the total shareholder return over rolling 5-year periods, is much more volatile than the economic returns of the indices that they track. So here you can see that both in the US market, but also in emerging markets. And basically when the two lines diverge, it is because investors are effectively re-rating or de-rating what they're willing to pay for retained capital that is being reinvested in the businesses. And we like to use the framework of Hooke's law, which basically is used to derive the elastic potential in a compressed or stretched spring in physics. And I think most people understand what we're trying to get at here, that the further away you get away from the equilibrium position, the greater the force pulling it back becomes. And that makes no difference if it's stretched or if it's compressed. So you can be undervalued or you can be overvalued. But the fact is that valuation serves as the equilibrium force. And in the same way, with company valuations, we know that profitable companies deliver intrinsic value growth over time, but the share price is much, much more volatile than that. Obviously, you want the slope of the red line to be high, better companies delivering higher returns, becoming worth more over time, but it doesn't mean that the margin of safety is necessarily there. So wherever you are on that black line, if you extrapolate forever, you will probably end up at the wrong point. And that's where we think we are at the moment. Here is the proof of valuation acting as an equilibrium force over the long term. We acknowledge that it's a pretty poor market timing tool in the short term, but here we look at the cyclically adjusted PE ratio for the US market on an inverted basis in the blue line. The further down the blue line goes, the higher the valuation of the market is. And as you can see, the subsequent 10-year real returns do follow that trend relatively closely over 10-year periods. So the more you pay, the starting point of valuation does matter for future returns. So if we use that kind of framework to think about both emerging markets, but also our value philosophy, I think we need to look at the opportunity in that context. Last summer, the FT asked if EM investing still makes sense or not. It has performed relatively poorly since the global financial crisis, but let's look at what has happened and what's driven that. So first question, is it fundamentally driven? Well, actually, developing countries continue to grow faster than advanced economies. That's what you want from your emerging markets exposure. Yes, some of the growth premium has narrowed since the heydays in the early 2000s, but on average, emerging markets are delivering roughly 2 to 2.5 percentage points faster growth. So the fundamentals are still supportive of EM growth. The second thing is you used to get growth and better return. So EM return on equity was higher than it was in developed markets, and although the gap has narrowed, emerging market equities still deliver similar returns to those of developed markets. Faster growth with similar returns is not usually a source of great underperformance, and the problem was valuation. So if we look at the height of the BRICS bubble prior to the financial crisis, these attractive characteristics were fully recognized by the market. Here you see on a price to book basis that EM equities actually traded at a modest premium to developed market equities, and that's despite weaker corporate governance and higher risks historically. This is no longer the case. As you can see, the gap has widened again. So if we look at the discount both on a price to book basis and on a PE basis, EM equities trade at now roughly 30% discount to developed market. And if we look in a historical context, in the blue line, when you have traded at these levels of discount, you have subsequently achieved strong relative returns the following 3 years. We saw as EM equities became more expensive prior to the financial crisis, that outperformance narrowed. And what we have seen now is that a gap has opened up again, which sets us up for a good risk reward in our view. Secondly, on the value factor, this is where we see the greatest opportunity and the potential for value stocks. This is a New York Times article from April 1999, which was the last time we had similar kind of market characteristics in our view. Here again, if we go through the same exercise, growth stocks understandably have higher ROEs than value stocks, but that's what funds the growth of growth companies. However, the gap between the two has been remarkably stable over the last 10 years at roughly 5 percentage points a year. What has happened is that the relative valuation between the two has exploded in size. So whereas 10 years ago, you paid a price to book premium of roughly 1 times for that 5% higher annual return, you are now paying 3 turns of book value differential. So in simple terms, you are now paying far, far more for that relative return premium than you have ever done historically. And here you see it in a slightly different way. So the 5-year ROE and the annual ROE in blue and green is relatively stable over time. So the difference between value stocks and growth stocks is not very different over time, but the dark line in the valuation has shot up, and that's what is the implied duration of what you think that growth differential can sustain. The pushbacks that we get on this is that many businesses are investing for the future, and future growth will be very strong, and today's earnings isn't what this is about. But if you look at on an EV to sales basis, which does not look at near-term profitability, we have also seen a significant re-rating of growth stocks relative to value stocks. And if we look at the last time in the US market, which is on the right-hand side, where we have data going back further, the last time that we were at these relative levels was during the dot-com bubble. And as you can see, style performance can change significantly over time. So the last time we were at these very, very different levels of valuation, value factor came back with a vengeance. And that is basically what we would argue is the Hooke's law of the equilibrium position and the spring being pulled back. If we use a newer example of that, we've also seen the same for emerging markets relative to developed markets. If we look at the period 2000 to 2010, US equities underperformed global equities in the post-dot-com era, and emerging markets equities delivered an annualized outperformance versus global equities of 12.5 percentage points per year for 10 years. But just as the dot-com crash flushed out previous excesses, so did the subsequent 10 years for emerging market equities when they had traded at high valuations. And you can see that the subsequent 10 years performance is a mirror image of what had happened the 10 years previous. And we see the same thing with the value factor. It's clear that the 2 decades have been mirror images of each other, where EM growth has underperformed the EM index in the first 10 years and subsequently have outperformed in the same way that value indices outperformed their growth indices in the period 2000 to 10, and then you've had a reversal of that relative performance in the subsequent 10 years. So if we look at the 2 real factors between that have been affecting the fund over the last few years, the emerging markets exposure, so the EM-DM relative performance in the blue line, and the value versus growth performance in the green line, both of those have gone through 2 significant 10-year periods of movement in one direction and then subsequent 10 years in the opposite direction. And as we see that emerging market equities are starting to come back to life, and we think that the risk reward on value stocks is even better, both on the valuation, but also on the recent performance metrics. So if we go into the portfolio, just lastly, before we open up for questions, on our reflection, the portfolio is trading at roughly 11 times this year's earnings, just under 1 times price to book. However, this valuation metrics are not at the expense of quality. When you look at the top 12 holdings in the portfolio, this is not a collection of state-owned Chinese banks that are trading at very low multiples, understandably. This is a portfolio of carefully selected regional or even global leaders in their field that have on average generated over 15% return on equity over the last 3 years, 6 percentage points more than the index average. In fact, when you look at on the right-hand chart here, the portfolio characteristics of high return on equity and low valuation puts us at a similar kind of quality bucket as the growth index, but at the valuation bucket of the value index. So in our view, you get the downside protection from the valuation characteristics of the portfolio, and you get the fundamental upside potential from the quality of the companies within it. So with that, I will open it up for questions, but in summary, we do not like to make macro bets and predictions, so we expect the backdrop to remain relatively challenging given what is going on around us. However, we do see a huge opportunity for value investment philosophy that we follow, and also the value factor that we have seen open up a huge gap against growth stocks. The valuation discount is unusually high in a historical context on any conventional metric, and we have also seen tentative signs of a turnaround in emerging markets, which we think has a really good chance of continuing. And as we showed in the introduction, we have made a number of operational changes in the portfolio, adding new companies that are making positive contributions that we think will position us well to take advantage of the opportunity as we see it.